Hi, and welcome back to the Business Career College video series. In this installment, we're going to look at the introduction to the taxation of life insurance. There are a fair number of concepts that we'll have to cover throughout this topic, so we'll break this down into several videos. The first thing that I want to emphasize, though, something that I'm sure everybody's aware of, is that a death benefit from a life insurance policy under ordinary circumstances, that is, virtually all the time, it's almost impossible to come up with an exception to this. A death benefit from a life insurance policy is paid tax-free. Do not lose track of that idea. Death benefits from life insurance policies are paid on a tax-free basis. What we are going to look at, though, are the various taxable dispositions of life insurance, and then we'll look at a quick example of how one of these taxable dispositions might break down. So different types of taxable dispositions we can have associated with a life insurance policy. We might have, first off, a surrender of the policy. And this sort of sets the model for the other dispositions that we'll see. A surrender is an attempt to get the cash associated with the policy, some or all of it. Some of it would be a partial surrender, and all of it, which would be a more common occurrence, would be a complete surrender. So we can have either a partial surrender or a complete surrender, both are possible. We might have an absolute assignment of the policy. This is when we had one person who owned the policy, and now that person is going to give somebody else ownership of that policy. Now, that's quite valid, but there is a pretty big exception to that, and that is when we have a parent who assigns a policy to a child, where the child is the life insured, or any time this happens between spouses. And that's pretty common to all kinds of property. The parent to a child exception, though, is really unique to life insurance. With other kinds of property, when a parent gives property to their child, that's a taxable disposition. With life insurance, we have ongoing tax deferral. Basically, the child just inherits the parent's life insurance consequences. We also have a taxable disposition if a policy is allowed to lapse and is not subsequently reinstated. Another assignment, or another taxable disposition, sorry. We can also have a taxable disposition of a life insurance policy, that is, tax associated with the policy, when there's a policy loan taken out. That policy loan does have tax consequences. Those are similar to a surrender, but not identical. I'll show you that math a little bit later on. And then we have a policy that fails the exempt test. That's also a disposition of that policy. And we'll talk about the exempt test and what it means to fail the exempt test a little bit later on. Sort of an odd one here, one that's not done much today, is the annuitization of a life insurance policy. Now that means you take the cash value associated with that policy and you spread that out. You take that as income over an extended amount of time. It's not that that's not a disposition. Sorry, that is a disposition. That would be disposed all at one time. There is an exception, though, and that is if the insured is disabled, then we spread that gain out over the life of the annuity. So a little bit of an exception there. It's not that it's not taxable, but rather we have some deferral where we get to take that income over an extended amount of time. Let's now have a look at a common example of a disposition of a life insurance policy. Now, here's the policy we're going to use. We're going to use a policy with a face value of $500,000. It's going to have a cash surrender value of $60,000, and we're going to have an ACB for this policy at $25,000. I'll show you later on how to calculate the ACB. The cash surrender value would just be the amount invested plus any growth, and the face value is how much would be paid if there's a death benefit. So the awkward thing here is that in order to get the face value out, there's really only one way to do that, and it's not ideal for most people. This would involve the death of the life insured. So you're not going to get that $500,000 out easily. If you want to actually take money out of this insurance policy and have it to spend, the cash surrender value is what's really available. And if you're going to take that whole cash surrender value, then you have what's called a complete surrender of that policy. And in a complete surrender, you are giving up your insurance, so there will be no more insurance here, but you'll get all your cash value. So no more premiums to pay, no death benefit, all that kind of stuff. So no more insurance, but the full cash value. Now, this is pretty straightforward actually. All we're going to do here with a complete surrender, we say, okay, you're going to have the $60,000, and we'll take that amount, that cash surrender value, minus the ACB. ACB is adjusted cost basis, and it's very similar to adjusted cost base, which we looked at back in capital gains, just that it's applicable to insurance. We have that little I in there to remind us it's for insurance, unlike capital gains, which have an adjusted cost base. Basically, those are the after-tax dollars that you put into this insurance policy. So we take the CSV minus the ACB, and we get the taxable policy gain. And then we would take that taxable policy gain and we would apply whatever the appropriate marginal tax rate is, and that would describe for us what your tax bill is associated with this particular event. So if we have a CSV of $60,000, which we do, and an ACB of $25,000, which we do, and we take the whole policy, we say I want the whole thing now, we would have a $35,000 taxable policy gain. We would apply then your marginal tax rate, and the marginal tax rate, let's say just for the sake of argument, is 40%. So 40% on a $35,000 taxable policy gain would give us a $14,000 tax bill. So you would get $60,000 out, you'd have $14,000 that you'd have to write as a check to clear that up, and you'd be in good shape. I hope that helps. That's the basics of taxation of life insurance. We're going to go on from this point and look at some more ideas with respect to taxation of life insurance. Thank you very much.